Foreign portfolio investors continue to be net buyers in the Indian debt market, pumping in nearly 16,500 crores in this month. In fact, they were net buyers in the month of January of about 19,300 crores, totaling this year's purchases up to 36,000 crores. They were also net sellers in the equity market of about 30,000 crores. Ahead of India's inclusion in the global indices and our fiscal deficit remaining under control, this raises a question. Can there be an opportunity in debt funds? Join us this Saturday where we understand and explore the opportunities in longer duration gilt funds.
Understanding impact costs. Most of us think that impact cost is something that affects us only when we go to sell, when everybody goes to sell at the same time, then the prices move down faster. So I may want to sell a share at 100 rupees, but I may end up selling only at 90 because everybody is trying to sell at the market rate. In that situation, my impact cost can become 10%. So when you sell for less, it pinches you, it bites you. So you feel that I have lost money. I should have made more money. I should have realized more. The fact that you're physically getting less money because everybody is trying to sell, and by virtue of everybody trying to sell at the same time, they are all creating an impact cost, you feel upset. Now flip this a bit. You are trying to buy a stock and everybody is trying to buy the same stock. You know, somebody recommends a stock at 9 o'clock on a TV channel and he's a very respected person, and everybody who's seen the TV channel rushes into the market at 9:15 and tries to buy. The stock starts at 100 rupees. The previous close is 100 rupees. But by the time you place your order and you buy the stock, you have bought it at 110 rupees. How do most people feel? They feel happy that they at least bought the stock at 110 rupees. Because the stock may end up at 113 or 114. So everybody goes home thinking that thank God I at least got it at 110. Nobody thinks that the stock that they should have bought at 100 actually levied an impact cost of 10% on them just before they bought. So when we buy, we tend to ignore impact cost, and when we sell, we never fail to ignore impact cost. But impact cost is a secular based. It's there when you buy, it's there when you sell. Sometimes your impact cost will be very low. You want to sell at 100 rupees, you sell at 99.75, marginal impact cost. You want to buy at 100, you buy at 100.25, very marginal impact cost. You don't have strong reason to complain, so you just go with it. But when it is significant, I would think 10% is a very high impact cost. 5% itself is a reasonable impact cost. But have you thought about what kind of impact costs we are paying in the market in the current scenario? How many people think about impact cost and how it affects them? Do mutual fund investors realize how impact cost is what they seem to be seeing as returns? What did I say now? What was this statement? Let me explain. Suppose you are continuously giving 3,500 crores to small cap mutual funds like we are doing now in SIP every month, month after month. Every month they have to put this 3,500 crores into the same set of stocks in their portfolio. It's highly unlikely that they're going to change the portfolio drastically every month. So every month, everybody knows that after the SIP money comes in, they have to be invested immediately. So brokers buy these stocks in the last week of a month so that they can sell it in the first week of the month to the mutual funds. Not only brokers, anybody, you and I, everybody is free to do that. So a smarter investor buys it in his personal capacity and he sells it during the SIP week, which is usually the first 10 days of the month. And inevitably the prices move up because in the last week people have dried up quantities. In the first week supply is lower, whereas these people have to buy and they buy it almost at the market rate, the prices move up. So month after month the SIP money is contributing to impact cost in small cap portfolios. Now imagine this scenario. You have an impact cost of at least 5% in my assessment. It could be higher in more illiquid stocks. We will come to know the composition of mutual funds portfolios and how much of it is in illiquid stocks when more data and more transparency is delivered to us. I expect that to happen soon. But think about this. If you are going to pay 5 or 10% while you buy itself, then you are almost giving away a significant part of the first year's returns to the selling shareholder. Now assume that the stock price was already high and impact cost has further added to your cost, then you are not giving 1 year's returns, you could even be giving 2 years returns to the selling shareholder. Which means this high impact cost could actually set you up for a situation where you may not make money at all because a lot of investors wait for 2 years and if they don't get returns, they sell the investment. Now see what happens when they sell the investment. The mutual fund has invested in illiquid stocks. While investing in illiquid stocks, prices have gone up because everybody is buying the same stocks. So they have acquired units at a higher price. And then when they sell, the same lack of liquidity comes back to bite and pinch. So when you sell again, you have to sell it with a high impact cost. So on both sides, investors have the risk of getting jammed and paying high impact cost. But in a rising market like we had in the last few years, nobody thinks that impact cost is a factor to be considered, a factor to be borne in mind, a factor to be always remembered while choosing a financial investment. And everybody is more than happy to mistake this impact cost for returns on the upside. And nobody thinks that this impact cost will contribute to negative returns on the downside. Friends, this is not normal, and impact cost is not something that you can ignore the way we are doing today. I just want to flag this, and time will tell you the merits of this point that I have just made. Thank you for watching this video.